You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast.
And we are looking at, well, a perfect storm to start the week. It is Monday, January 26, 2026.
A perfect storm is right. We've got currency intervention risks, commodity prices just smashing records, and political dysfunction all colliding at once.
You can really feel the tension. It's like the market is holding its breath.
Absolutely. We're seeing this massive shift in the Japanese yen that hints at coordinated action between Washington and Tokyo.
Right. Just as gold is blowing past historic ceilings and the U.S. is facing another government shutdown threat.
So today we're going to break down why the Federal Reserve might be checking exchange rates, why Arctic weather is spiking gas prices, and how trade tensions with Canada are rattling the dollar.
Let's unpack it.
Okay, I want to start right at the center of that storm, which for me is the currency markets. That seems to be where all the real drama kicked off.
Late last week and right into this morning.
We're seeing some incredibly wild moves in the Japanese yen. For the longest time, the trade was simple, right? Just short the yen.
Bet on it getting weaker. Easy money.
But suddenly, we've seen this aggressive surge. It's strengthened from near 155.7 against the US dollar all the way down to lows around 153.4.
That is a massive move. You just don't see moves of that magnitude over 200 pips without some kind of a significant catalyst.
So what was it? What triggered this sudden U-turn? Markets don't just change their mind on a dime.
No, they don't. It's a combination of rhetoric and the credible threat of action.
Okay.
You had the Japanese Prime Minister, Takaichi, come out very strongly, warning against what she called speculative moves.
But we hear that all the time from politicians.
We do. And that's why the real smoking gun, the thing that actually woke traders up, was this report that the New York branch of the Federal Reserve conducted rate checks on the dollar-yen pair.
All right, let's unpack that term because a rate check sounds so benign. It sounds like someone just looked at a screen.
Right.
But in central banking terms, this means something much more specific, doesn't it?
It does. It's a signal. Think of it like a police officer tapping their baton on their hand while making eye contact with you. They haven't done anything yet.
But they're letting you know they're there.
Exactly. They're letting you know they're watching and they're ready to step in. When the Federal Reserve calls dealers to ask for a price check, they're signaling they're preparing for a potential intervention. It's the step right before you start buying or selling.
That is a great analogy. So the market sees this and thinks, okay, Washington and Tokyo are coordinating. But here's what's so interesting to me. Why does the U.S. care?
Yes.
Usually it's Japan wanting to save their own currency. Why would the Federal Reserve get involved in strengthening the yen?
And that's the fascinating part. It's
Yeah.
about the plumbing of the global financial system. You have to remember, Japan is the largest foreign holder of U.S. government debt.
Okay.
So a critically weak yen was causing a sell-off in Japanese government bonds. When Japanese yields go haywire, it often forces those investors to sell U.S. treasuries to cover their losses.
So a crash in Japan's bond market was bleeding over and pushing up interest rates here in the United States.
Exactly, pushing U.S. Treasury yields higher. And when those yields spike, everything from mortgage rates to car loans gets more expensive for Americans. So U.S. policymakers likely realized that to stabilize their own market, they had to stop the yen from falling further.
It's self-preservation.
Completely.
Hmm?
And then there's the trade angle, too. The current administration is heavy on tariffs. But tariffs don't work if the other country's currency just collapses.
Right. A cheap yen would just offset the tariff.
A good cheap yen makes Japanese cars and electronics incredibly competitive anyway. So Washington has a vested interest in a stronger yen to make sure those trade barriers actually, stick.
And from a technical standpoint, looking at the charts, this move seems pretty significant. The currency dipped below its 100-day moving average.
And for the technical traders out there, that's a really big deal. When you break a long-term trend line like that, it often signals a psychological shift. It tells the market that the old trend of just betting against the yen might be over for now.
Okay, so while the currency markets are stressing about intervention, the commodities market is just going absolutely parabolic. I mean, we have to talk about these numbers. Gold pushing beyond $5,100 per ounce.
And silver nearing 110. These are historic numbers. We're deep in record territory.
I remember when $2,000 gold seemed like a crazy ceiling. Now we're at 5,100. What is driving this? Is it just inflation?
I don't think so. Not just inflation. This isn't your standard inflation play. It's moving way too fast for that. This is what we call the fear trade.
A systemic hedge.
Exactly. Gold at this level isn't about the dollar losing a few cents of purchasing power. It's about a loss of faith in the stability of the system itself. Investors are looking at geopolitical stress, currency instability, like what we just discussed with the yen, and all the political chaos in Western capitals.
Which we'll definitely get to in a minute.
And when you combine all of that, investors just want hard assets. They want something that doesn't rely on a government's promise. That's why you see this relentless bid for gold and silver.
What's so interesting, though, is that crude oil is surprisingly boring right now. West Texas Intermediate is hovering near $61, Brent near $65.
It is a strange divergence. The Organization of the Petroleum Exporting Countries, OPEC+, is likely just going to maintain its supply pause in March. They're looking at the market and saying, we don't need to do anything crazy yet. The physical market for oil feels adequately supplied.
But then you look at natural gas, and it's a completely different story.
A completely different world. Natural gas is exploding. U.S. Henry Hub futures are above $6. That's the highest we've seen since the start of the Ukraine war.
And this isn't geopolitics, is it? This is just Mother Nature.
Mostly, yes. It's a severe supply shock caused by weather. We have these Arctic conditions that have essentially frozen operations. It's called a shut-in.
Explain what that is.
So natural gas wells often produce water with the gas. When it gets this cold, that water can freeze inside the pipes and wellheads. It literally clogs the plumbing.
So they physically cannot get the gas out of the ground.
Correct. And roughly 10% of U.S. production has been shut in because of this.
10% is a massive chunk of supply to lose overnight.
It's huge. And it's not just here. We're seeing cold snaps in Europe and Asia, which drives up demand at the exact same moment that supply is being cut. So while oil traders are relaxed, natural gas traders are in full-blown crisis mode.
So we've got currency manipulation, gold skyrocketing on fear, weather shutting down energy grids. And of course, Washington decided to throw a renewed government shutdown threat into the mix.
It really is a pick-your-poison kind of week.
We have Senate Minority Leader Chuck Schumer now threatening to withhold funding for the Department of Homeland Security. This is all stemming from that shooting involving a Border Patrol agent.
That's right. And whatever your politics are on the incident, the market impact is what matters here. It reintroduces political risk directly into the value of the U.S. dollar.
And the dollar index opened lower because of it.
A big part of it is this domestic instability. When international investors see a government that might just shut itself down because of political infighting, they get nervous. They sell the currency.
But there's another layer to this dollar weakness, and it involves Canada. President Trump is threatening 100% tariffs.
Yes, specifically if Canada goes and strikes a trade deal with China. It's a classic example of using trade policy as a geopolitical weapon.
The currency reaction was immediate. We saw the U.S. dollar-Canadian dollar pair drop below 1.37. But wait a second. That means the Canadian dollar got stronger.
Right.
That seems counterintuitive. Usually, if you're threatened with tariffs, your currency takes a hit. Why did the loonie strengthen?
That's the nuance of this specific moment. Usually, yes, tariffs would hurt the target. But in this case, the broad weakness of the U.S. dollar, driven by those shutdown threats we just talked about, it just overpowered the tariff risk. The market is punishing the U.S. dollar more than it's punishing the Canadian dollar right now.
That is a very telling signal. Is the dollar weak against everything?
Pretty much. The one exception is the euro. The euro is kind of stalling out around 1.19. The European data is just uninspiring, so there isn't much momentum there.
But the Aussie dollar is having a field day.
The Aussie dollar is basically trading like a proxy for gold. It's up to 0.69. You just have to remember, Australia is a massive commodity exporter. When gold and metals surge, its currency tends to go along for the ride.
I want to zoom out a bit. We talked about the fear trade. A lot of that is coming from actual conflict zones. We've got news from Eastern Europe about Ukraine striking a Russian oil refinery in Krasnodar.
Yeah, that's a continuation of the strategy to target Russia's energy infrastructure. It keeps that risk premium in the market high. And at the same time, you have these conflicting narratives about peace talks. It's the fog of war. Markets can price bad news, but they can't price uncertainty.
And the European Union is finally putting a hard date on cutting off Russian gas for good this time.
They've approved the ban. Liquefied natural gas by January 2027 and pipeline gas by September 2027. It's a major policy shift. It signals the energy landscape in Europe is permanently changing.
Burning the bridges, so to speak.
They are. And then you look to the Middle East, and the tension is just as high. Iranian officials are warning of forceful responses. Israel is bracing for retaliation. It feels like a very fragile equilibrium.
So all of these flashpoints, Ukraine, the Middle East, the U.S. shutdown, they all feed back into that safe haven demand we talked about.
They do. It's a feedback loop. Geopolitical instability fuels gold. Higher energy prices hurt growth. And the dysfunction in Washington makes the dollar a less attractive place to hide.
Given all of this, how are equity markets handling it? You'd think stocks would be tanking.
They're uneasy. It's not a panic, but it's a very cautious open. U.S. futures are trading lower. Europe is mixed. Travel and tech stocks are down, which makes sense.
But resources are up.
Of course. Mining and energy stocks are up because of commodity prices. It's a rotation. Investor psychology right now is just very hesitant. There's a lot of fog.
So what are we watching this week that could maybe provide some clarity?
There's a lot of data. The big ones are the Chicago Federal Reserve National Activity Index and then durable goods orders. We also have the Atlanta Federal Reserve's growth tracker.
Why are those so important right now? Durable goods sounds a bit dry compared to gold hitting 5,100.
It sounds dry, but it measures big-ticket items, machinery, airplanes. It tells us if businesses are still confident enough to make long-term investments. The market is trying to solve a puzzle. Can the real economy handle all this political stress?
So if the data comes in hot, it suggests resilience?
Right, but if the data disappoints and we still have all this political chaos, that is a very bad combination for risk assets. That starts to look a lot like stagflation.
It feels like we're walking a tightrope. On one side, you have the real economy, and on the other, you have this layer of political and geopolitical interference just distorting everything.
That's the defining tension of the week.
You know, I want to leave our listeners with something to think about here. We started by talking about the Federal Reserve potentially checking rates on the yen. And we know the U.S. administration wants a weaker dollar for trade, but it's creating these domestic risks, like a shutdown, that weaken it for the wrong reasons. It just raises a question for me.
Go on.
If the Federal Reserve is coordinating with the Bank of Japan to manage currencies, are we entering a new era where central banks, not free markets, are deciding the value of money?
It's a profound question. Are we looking at a managed global economy where the price of your currency is determined by a phone call between Washington and Tokyo instead of supply and demand?
Because if the price of money is managed, then the price of everything else is distorted. It feels like the invisible hand of the market is being replaced by the very visible hand of policymakers.
A lot to think about there.
That's it for today. Thanks for being here. We'll catch you in the next one.
Appreciate you tuning in. Join us again on the Financial Source Podcast.